So you want to get started with investing. Maybe you've saved up some money and you don't know how to get started. Probably you've seen the news of how Amazon, Tesla and Nvidia stock all went up, and how if you would have invested 10 years ago, you would have been a multi-millionaire today. It is overwhelming to get started with investing. I feel you. Back in the days when I was trying to figure out investing, I would just throw my money at investments left and right, hoping that one of those investments would just make me super rich overnight. But in reality, the exact opposite happened. I lost a bunch of money. Looking back, I now realize that I wasn't an investor. I was a gambler. I had no game plan, I had no idea of what I was doing. I was approaching the market like a casino. And with gambling, the casino always wins. So I had to go back to the drawing table and I had to educate myself on the topic of investing. Now I'm a multi-millionaire at the age of 31, and one of the skills that really helped me to build my wealth is the skill of investing. In this video, I'm going to give you a complete overview of how you can get started with investing, but most importantly, how you can avoid costly mistakes and a lot of frustration having to figure this all out by yourself. Let's dive in. Unless you've been living under a rock for the past few years, you've probably seen the news headlines about the trillions that have been printed to keep our economy afloat. And the more money is in circulation, the less every unit of money is worth. And we have a special term to describe the devaluation of our money over time. And that word is inflation. So is inflation a bad thing? Well, economists actually agree that a 2% inflation rate is actually healthy. So what does a 2% inflation rate mean? Well, it means that your money is able to buy 2% less in the future than it is able to get you today. So why is a 2% inflation rate healthy? Well, the assumption is when people know that their money will be worth less in the future, they will start to spend it or invest it rather than having it sit in their bank account. And this will result in more money flowing through the economy. Most people are unaware of the massive impact that inflation has on their daily lives. So that's why I want to illustrate the effect of inflation with a very easy to understand example. Let's say that you have $100 or 100 euros or 100 pounds in your bank account or whatever currency you have. The currency is irrelevant. You have 100 units of money in your bank account. With those 100 units of money, you want to buy Nutella. Who doesn't love chocolate, right? So here on my screen, I want to show you this example. Let's say that today you have 100 units of money in your bank account. A price of a pot of Nutella today is 2 units of money, so $2. How many pots of Nutella can you buy? Well, this is not rocket science. You can buy 50 pots of Nutella. But if the inflation rate is at 2%, then it means that the prices of your pot of Nutella is becoming more and more expensive over time. Why? Because your money is becoming worth less. More money in circulation means that every single unit of money becomes worth less. You can buy less products and services with that same unit of money. So in 5 years from now, the price of a pot of Nutella is $2.20, whereas you still have the same $100 in your bank account. So if you would calculate how many pots of Nutella you would be able to buy in 5 years from now, you would be able to buy around 45 pots of Nutella. So you can actually buy less pots of Nutella than you can buy today. In 10 years from now, the price of a pot of Nutella will be $2.44. So with that same $100 in your bank account, you will be able to buy 41 pots of Nutella. In 20 years, it's even worse because the price of a pot of Nutella has increased to almost $3. So you can buy around 33 pots of Nutella. And in 30 years from now, the price of a pot of Nutella will be around $3.62, meaning that in 30 years from now, with the same amount of money that you have today, you can buy almost just half of what you can buy today. And that is how quickly our money devalues over time. And this is only with a 2% inflation rate. In reality, the inflation rate can actually be a lot higher than just 2%. Here on my screen, I want to show you the inflation statistics of the US economy. Here you see in the 1980s, the inflation rate was almost 15%. Do you realize what this means? This means that your money becomes 15% worth less compared to 1 year earlier. And we've seen such high inflation rates in the previous years as well. Like here recently, we saw that during COVID, inflation rates reached almost 10% here in 2008 or something like that. We also saw an inflation rate of almost 5%. And that's not, of course, only the US economy. This is true for all economies around the world. We're seeing inflation in nearly every economy around the world. So I want to show you as another example to prove that it's not just the US economy. I want to show you the inflation statistics of the Eurozone. Here you see that the inflation in the Eurozone in 2022 was almost 7% and even 10% in October of 2022, meaning that our money became 10% worth less in 1 year. So it shouldn't come as a surprise to you that everything around you is slowly becoming more and more expensive. Now that you understand the impact that inflation has on your life, you have two options to cope with that inflation. Option number one is you decide that you're going to work harder so that you can make more money to maintain your current lifestyle. However, we humans, we have only 24 hours in a day. It's not possible to magically create 25 hours or 28 hours. There's always a limit to how hard and how much we can work. And in addition to that, I would hate to see you to get into a burnout. The second option that you have to cope with this inflation is to accept that everything around you is becoming more expensive, and as a result, you'll just have to downgrade your lifestyle. For me, neither of these two options were good solutions. So I set out to find another solution to the problem of inflation. And that's when I discovered investing. So what exactly is investing? Well, explained in its simplest form, investing means that you're spending your money on things that can make you more money, either through the form of an increase in the value of the thing that you've purchased, or because the thing that you bought pays you an income. So examples of these kind of investments are stocks, crypto, real estate, and even watches. By putting your money into investments that can increase in value over time or that pay you an income, you can actually multiply your money over time. And as a result, you're able to beat inflation and upgrade your lifestyle. To illustrate this, I want to show you the example of the pot of Nutella that we've been using before, but this time I'm also going to show you the scenario where we are actually investing our money. Here you see the example of the money in your investment account. So today we start with 100 units of money in our investment account. We assume an average yearly return of around 7%. That is something that has been historically able to achieve by investing just in a simple index fund like the S&P 500. And we assume an inflation rate of around 2%, which is also the historical average inflation rate. So we are working with historical averages over here. So let's say that today we have got 100 units of money in our investment account. The price of a pot of Nutella is 2 units of money. Then today we can buy 50 pots of Nutella. But if our money actually starts to compound at a 7% annual return, then in 5 years from now, we have not 100 units of money in our investment account, but we have 140 units of money in our investment account. Of course, the price of a pot of Nutella has increased as well because of inflation. So the price of a pot of Nutella is not $2, but $2.20. So this means that we can buy 64 pots of Nutella in 5 years from now. Do you see the difference between not investing our money, where in that scenario we were only able to buy less and less over time, and now you see by investing our money we're able to buy more pots of Nutella in just 5 years time. Let's have a look at the scenario of investing our money for 10 years at a 7% annual return. Then in 10 years we would be able to buy 80 pots of Nutella instead of 50 pots today. In 20 years from now, of course, the money in our investment account has grown, but also the price of Nutella has increased because of inflation. But still, we are able to buy more pots of Nutella. Actually, we were able to buy 133 pots of Nutella. And in 30 years from now, we are able to buy 210 pots of Nutella. Rather than buying 50 pots of Nutella today, if we would invest that same amount of money and we would just keep it there, invested at a 7% annual return, in 30 years from now, we would be able to buy 4 times more of the products and services that we're able to buy today. Hopefully now you see the power of investing, because with investing you can beat inflation and you can upgrade the quality of your life, because your purchasing power will actually become more and more over time. In this video, I'm going to be focusing in particularly on investing in stocks. Why? Because that is one of the easiest ways to get started with investing, regardless of how old you are and regardless of where you are located in the world. One question that I often get is, hey Mitchell, isn't investing risky? And my answer to this is no, investing isn't risky. The behavior of people is risky. You see, most people approach investing like they're in a casino. They've got no clue what they're doing and they're just randomly throwing money left and right, hoping to get rich quick. They have a sort of lottery mentality. But that is not how you invest. When you look at the Forbes list of the richest people in the world, many of the people on that list actually built their wealth with investing, and none of them attribute their success to just good luck. No, if you want to succeed as an investor in the markets, you need to create your investing game plan, and you need to stick to that game plan over time, regardless of what the news says, regardless of what your friends and your family members are saying, and regardless of what companies and projects your favorite influencers are shilling on YouTube, Instagram, and TikTok. And this will help you to decouple your investment decisions from your emotions. In your investing game plan, you're going to outline what investments you're going to make, at what intervals you're going to make them, and how much of your money you're going to allocate to each of these different investments. Of course, if you're going to make your investing game plan, you need to have a general idea of the different types of investments. And that's the reason why I'm putting this video together for you. Let's start with the first type of investment, ETFs. ETF stands for Exchange Traded Fund. It's like buying a basket of different companies or investments, all with just a few clicks of a button. You can buy ETFs on most stock brokerage accounts. And there's three main benefits to buying an ETF compared to picking individual stocks. First of all, the main benefit is you don't have to do stock picking. You don't have to do your research. You don't have to analyze companies. You don't have to analyze financial reports. You don't have to pick individual stocks, because with ETFs, you get exposure to many different companies or many different investments all in one go. And the nice thing about this is whenever you get exposure to a larger basket of companies, no matter if one of those companies is performing poorly, the other companies might be performing a little bit better. The performance averages out. That is really nice to diversify your risk. And that brings me to the second benefit of investing in ETFs, that is diversification. So by getting exposure to many different companies instead of just one company, the performance of your stock portfolio isn't just dependent on the performance of a single company, which statistically can go up or down a lot. You know, many different things can happen in the market, and by gambling on just one single horse or putting your eggs in a single basket, you are putting yourself at risk. And then the third benefit to investing in ETFs is of course the transaction fees. So imagine that you want to buy 100 different stocks. Every time that you make an investment in one of these stocks, you pay a transaction fee to the brokerage platform. But if you buy an ETF, you only pay transaction fees once. So yeah, this is just a lot more cost effective to get exposure to companies rather than buying each of these individual stocks yourself. So there's 5 different types of ETFs which I want to discuss here in this video. The first type of ETF that I want to discuss are geographic focused ETFs. These are ETFs which give you exposure to companies in a particular geographic region. For example, an emerging markets ETF will give you exposure to companies in India, Mexico, or Brazil. Or a Europe ETF will give you access to companies that are based in, you guessed it, Europe. The second type of ETF that I want to share in this video are dividend ETFs. Basically, what dividends are, those are distributions of profit that companies give back to their shareholders. So basically, by holding a share or owning a share of a particular company, you get a quarterly, monthly, or even yearly cash flow from just holding that investment. One example of an ETF is a high yield dividend ETF. This basically gives you exposure to companies that have a certain dividend policy. They want to pay out a certain percentage of dividends every single year, or they want to pay out a certain percentage of their profit every single year to their shareholders. So yeah, those are really great ETFs if you want to generate a cash flow from your investment portfolio. The third category of ETFs that I want to share here in this video is market cap based. So what does market cap mean? It stands for market capitalization. In very simple terms, it refers to the size or the value of a company. So if we're talking about large cap companies, we're talking about large companies. One of the most common used example of a market cap based ETF is the S&P 500, which is a basket of the 500 largest companies on the US stock exchange. But we also have small to mid cap ETFs, which will give you exposure to, you guessed it, smaller to medium-sized companies that are traded on the stock exchange. The fourth category of ETFs is the industry-focused ETF. By buying an industry-focused ETF, you will get exposure to a particular industry or sector. For example, an oil and gas ETF will give you exposure to a basket of companies that are in the oil and gas industry. Rather than having to buy a single company in the oil and gas industry like Shell, you get access to a bigger portfolio with just one click of a button. And this is really great if you want to diversify your portfolio and manage your risks. The final category of ETFs that I want to share in this video is the asset class focused ETF. In investing, we've got many different asset classes: stocks, crypto, real estate, bonds, and precious metals. And there's many more asset classes out there. And we even have ETFs that give you exposure to either companies that are focused on a particular asset class, like a gold mining ETF, which give you exposure to different companies in the gold mining space. But you can also buy a gold ETF, which gives you exposure to a fund which owns physical gold on your behalf. And by buying into one of these ETFs, you can get exposure to a particular asset class. Now, lots of people will try to convince you that a mutual fund is superior to an index fund. What is a mutual fund? Well, a mutual fund is very similar to an ETF. The only big difference is that a mutual fund is managed by a very smart person whose job it is to pick the stocks that will go into the mutual fund. But in most cases, you are just much better off putting your money into an index fund with a lot lower risk and a lot lower fees. The S&P 500 charges around 0.07% every single year, whereas most mutual funds would charge you between 1 to 2% of your account balance in fees every single year. If you would invest $10,000 into a mutual fund, it means that every single year, $200 of that would just go to the fund manager's wallet, regardless if he lost money due to poor stock picks. On the flip side, with the S&P 500, only $7 would go to fees. Yes, just $7 leaving your account on a yearly basis for holding that investment. That is relatively so much lower than you would pay with a mutual fund. This is because index funds are passively managed, and this means that we don't need to pay for an expensive fund manager that may or may not be doing his or her job. For long-term investments, I generally like Vanguard a lot. I'm not affiliated with Vanguard by any means, but I think Vanguard index funds and ETFs are just really easy to buy and hold, and they generally have really low fees, and that's what I like to see as an investor. Now let's talk about picking individual stocks. As a beginning investor, I wouldn't recommend you to get into picking individual stocks because it requires a little bit more knowledge and a little bit more effort to pick the right stocks. But regardless, I'm still going to share my philosophy about picking individual stocks here in this video with you. One question that I want to ask you is, which stock would you invest in? Tesla or Coca-Cola? I'm pretty sure many of you watching this video would actually pick Tesla. Which brings me to the following. Have you ever heard the name Warren Buffett? He is one of the best investors in history. In the course of his lifetime, he has built up a net worth of over $100 billion with investing. I have studied Warren Buffett in the past few years because I believe that success leaves clues. Warren Buffett says that he prefers to invest in boring, stable, and predictable companies instead of new, sexy, and disruptive. If we go back to the example of Coca-Cola versus Tesla, let's have a look at what Tesla is actually doing. Tesla is a pioneer in the electric vehicle space. Every year it's spending billions on inventing its technology and improving its technology and creating a market to sell its products to. But it is not always a guarantee that the pioneering companies will actually become the dominating companies in the future, because there's always a second and a third wave of companies that are simply looking at what the pioneering companies are doing. They're learning from what is working well, and they're learning from their mistakes to avoid what didn't go well, and ultimately they bring out a superior product. So is it a guarantee that Tesla will exist in 100 years from now? No, absolutely not. In fact, the statistics are stacked against it. Which brings me to the following question. Will Coca-Cola exist in 100 years from now? What do you think? Let's have a look at Coca-Cola's business model. It's actually very simple. Coca-Cola sells sugary water, and millions of people from all around the world are addicted to it. Will this change? Probably not, even in 100 years from now. And that is why Warren Buffett prefers to invest in boring, stable and predictable companies compared to sexy, new and disruptive. And that is my philosophy too. And in the remainder of this video, I'm going to share two categories of boring, stable and predictable stocks which tend to win over the long term. The first category is called the Dividend Aristocrats. These are really great for investors that are looking to generate a cash flow from their investment portfolio. Before I'm going to explain what these Dividend Aristocrats are and what companies are on this list, you need to understand that there's three things that a publicly traded company can do with its profits. Number one, it can reinvest its profits back into its growth. For example, it can hire more people, it can spend its money on R&D to develop new products and services, can buy new equipment. Yeah, that's all part of reinvesting back into the growth. Then the second thing a publicly traded company can do with its profits is to decide to pay a chunk of those profits back to the shareholders for believing in the company, taking the risk to invest in that company and being a loyal shareholder. And this is what we call a dividend distribution. And then the third thing that a publicly traded company can do is to buy back its shares on the open market. And by buying back the shares on the open market, the supply of shares on the market becomes smaller, hence the value of each share increases. There's a special category of stocks called the Dividend Aristocrats. And these stocks are known for paying out good chunks of their profits back to their shareholders. Hence, Dividend Aristocrats. So let me show you the list of Dividend Aristocrats. You can simply go to Google and you can find many lists of Dividend Aristocrats. I happened to stumble on this list by accident. So this is a 2024 list of the Dividend Aristocrats, which now contains 67 Dividend Aristocrats. For a company to be called a Dividend Aristocrat, it needs to be part of the S&P 500 index, which is the index of the 500 largest publicly traded companies on the US stock exchange. And it needs to increase its dividends for at least 25 years in a row. So every single year, it needs to increase its dividends. So all of the companies that you're seeing over here are really focused on paying out dividends to its shareholders. Otherwise, they are not able to remain on this list. And the fact that they're focused on paying out profits to their shareholders really is a good sign that they're focused on maximizing shareholder value. And some of the names of the companies on this list are Cisco. You can see the ticker symbol, the full name of the company. You can see the industry. You can even see the dividend yield, which is the relationship of the dividend compared to the value of the stock. Here you can see Kimberly-Clark, AbbVie. You can see 3M, Chevron, Exxon. Those are all part of the Dividend Aristocrats. So these are proven, boring, stable companies which generally tend to increase their dividends every single year. If a company fails to increase its dividends while they're on the Dividend Aristocrats list right now, then next year they will be taken off this list. And these companies really like to be on this list because it puts them on the radar for investors. Investors love these kind of stocks for a reason. So now you know a little bit more about the Dividend Aristocrats, what companies are on this list, and how you can find this list yourself. Let's move on to the next category of stocks that I want to share with you. That final category of stocks is REITs. REIT stands for Real Estate Investment Trust. It's basically a publicly traded company which invests in real estate on behalf of its shareholders. So some of the benefits of investing in REITs compared to owning real estate yourself, that is number one, if you want to buy real estate, you need to make a down payment on your house. And oftentimes you need to have 30, 40, 50K saved up before you're even able to buy your real estate property. This makes it very hard for most people, and for some people even unachievable, to make a down payment on a property. So REITs give you an easy solution to just get exposure to real estate with 80, 100, 150 euros. You can already buy into a really great REIT. The second one is diversification. By investing in a REIT, you get exposure to not one property, but a whole portfolio of different properties in different industries, in different geographies. So again, this is really great to diversify your portfolio and to manage your risks. And the third benefit of investing in REITs is that by investing in a REIT, you can actually piggyback off some of the smartest real estate investors in the industry. Whereas if you would have to buy your own properties, you would have to figure out the wheel yourself. In fact, investing in real estate can actually require you to put a lot of your own time into it. And if you don't know what you're doing, you can actually make some very costly mistakes. So why not let other people who are professionals, who have a very great track record in this space, do the work for you? One REIT that I really like is Realty Income Corp, stock ticker O. Please don't take this as an investment tip. I'm not endorsing this company at all. I'm just trying to give you an example of a REIT to make it tangible. So here, by going to this company's website, Realty Income Corp, we can actually get an understanding of what they're doing. So you can click on their portfolio and you can see that they have over 13,000 different properties with over 1,300 different clients in 85 separate industries. Here you see a map of where their real estate is located and the percentages of their real estate according to those locations. You can read a lot about their clients. So here they've got massive clients like Sainsbury's, which is a supermarket chain, 7-Eleven, Lowe's, Chipotle, which is a fast food restaurant. So they've got many big clients, they've got many different properties, many different industries, and I really like it because that shows me that they are well diversified. And in addition to performance, they have been performing really well. They've generated a 13.4% compound annual return since they basically got listed on the stock exchange. I just wanted to show you this as an example of a REIT that might be interesting. The topic of investing is a very interesting field. In my opinion, we should have learned these very critical skills of money management and investing at school, but we didn't. That's why it's our own responsibility to educate ourselves. If you want to see more videos like these on these two topics of money management and investing, then be sure to subscribe to this channel, because I'm going to be posting more valuable tutorials and I'm going to be posting more videos where I share my personal insights and journey of learning how to invest my money and becoming a multi-millionaire at the age of 31. All right, thank you so much for watching this video. I'll see you in the next one. Peace out.